Welcome to AI Explains ICT. In this video, we're going to build a professional-grade filter for the London trading session, and this is all based on the incredible insights from Core Content, Month 8, Episode 6. The goal here is simple but absolutely crucial, to master the most important skill in trading, and that is knowing when to just sit on your hands and stay out of the market.
We're going to be focusing on a framework that's designed to do one thing and one thing only: protect your capital by helping you avoid those really low probability setups.
Now, what's really unique about this particular lesson is that ICT provides zero charts. Yep, you heard that right, and that's totally intentional. The entire focus is on the rules, the logic that really separates the pros from everyone else. So I highly recommend you grab a pen and paper or open up a notes app, because getting this framework burned into your brain is an absolute game changer.
All right, so here's our game plan for today. First, we'll talk about what a professional filter even is. Then, we'll get into the big, high-level warnings from the daily chart and the economic calendar. After that, we'll zoom into the nitty-gritty clues you can find right before the session starts. Once we know what to avoid, we'll flip it and define what the ideal London setup actually looks like. And finally, we'll wrap it all up with the mindset that makes it all work: the discipline of abstinence.
Okay, so what exactly is a professional filter? Well, it's not about finding more trades. It's actually the complete opposite. It's a systematic checklist that's designed to protect you from low probability environments. As ICT explains, any amateur can find some reason to click a button. The real professional edge comes from spotting when the market conditions are working against you and having the discipline to save your capital for those A-plus setups.
So our filter starts at the highest level, the daily chart, and the economic calendar. I want you to think of these as the major red flags you have to clear before you even consider looking at an intraday setup.
First up, the daily chart. If the previous day was a huge expansion day, we're talking a range more than double the 5-day average, the market is probably exhausted. You should expect choppy consolidation, not a clean continuation. It's just gassed out. Similarly, after 3 straight up-close days, the market is overextended. This is not the time to be looking for longs in London. And, you guessed it, the same logic applies in reverse. After 3 down days in a row, the professional move is to step aside from short positions.
Next, the economic calendar. This is huge. If a major event like FOMC caused that wild whipsawing price action yesterday, London is likely to be the messy hangover. Just stay out. The same thing goes for the day of non-farm payrolls. The market will often just sit there and wait. Also, be really wary of the day before a holiday or a long weekend. Why? Because institutional traders are heading out early, liquidity dries up, and that leads to really unpredictable moves. And finally, if the calendar is packed with multiple high-impact news events right during the London session itself, well, that's just a recipe for chaos.
But here's the really interesting counterintuitive twist from ICT. While a busy calendar is a warning, a completely empty one can be a wild card. The market might be dead quiet, or, as ICT notes from his experience, a surprise event can hit a low-liquidity market and trigger an enormous, unexpected move. The bottom line is, it signals unpredictability.
Okay, so once those high-level checks are clear, we drill down to the next layer of our filter, analyzing the market's behavior in the hours leading right up to the London Open. This is where we hunt for some very specific clues in the overnight price action.
Our first checkpoint is what ICT calls the central bank dealer's range. This is the window from 2 p.m. to 8 p.m. New York time. It basically captures the market activity from the New York close all the way through the start of the Asian session, and that gives us a great baseline for the overnight sentiment. And here's a critical rule for that window. If the range expands beyond 50 pips, it is a major red flag. This suggests that the big institutional moves may have already happened, leaving a volatile and unpredictable environment for the London session. For ICT, a range this wide is a strong signal to simply pass on the day.
All right, immediately after that, we assess our next piece of the pre-session puzzle, the Asian range, which runs from 8 p.m. to midnight New York time.
The rule here is very similar. If the Asian range expands to more than 40 pips, it's another clear warning sign. A wide Asian range often means the expected move for the day has already started, or maybe even exhausted itself before London traders even get to their desks. The potential for a clean, powerful move out of the open is just drastically reduced.
So let's put it all together. The ideal scenario, what you're really hoping to see, is a small, tight consolidation. Both the central bank and Asian ranges are quiet in their overlapping.
ICT explains this is when institutional orders, both buy-side and sell-side liquidity, are just being built up and accumulated above and below the range. Now, on the other hand, what you must avoid is a market that is already trending or moving erratically. If you see this, the institutional move is already underway, and London is likely to just be the sloppy aftermath.
Okay, so we've built a really powerful filter to keep us out of trouble. But that raises the obvious question, right? What does a perfect, high-probability setup actually look like?
So let's flip the script now and define our green light conditions. After all the red flags are absent, these are the positive factors that signal a prime environment for a clean, high-probability London trade.
A perfect setup has 4 critical components that absolutely must align. First, a clear daily bias, meaning the daily chart is cleanly respecting key price levels or PD arrays. Second, an obvious target. Price is clearly being drawn toward a specific area of liquidity, what ICT calls a premium array, which is an area of sell-side liquidity, or a discount array, an area of buy-side liquidity. Third, volatility is coiled. The daily range has been quiet recently, suggesting a big expansion is due. And fourth, as we just covered, you have that pre-session calm, a tight, clean consolidation. When these 4 elements align, the probability of a powerful move is really stacked in your favor.
This table simplifies that logic just beautifully. Your entire objective in the London session is dictated by the story the daily chart is telling you. As you can see, if the daily chart shows prices trading up towards a premium array, an area of sell-side liquidity, your only job in London is to find reasons to get long. Conversely, if price is clearly heading down towards a discount array, your entire focus for the session should be on finding high-probability short setups. You're simply aligning your intraday actions with that higher time frame narrative. Now, having a list of rules is one thing, but consistently following them requires a specific mindset. This final section is about the psychological bedrock of this entire framework, what ICT calls the discipline of abstinence.
ICT puts it very simply, and this is a crucial takeaway. If your analysis, using the filters we've just built, indicates the market is conditioned for London slop, the single best trade you can make is no trade at all. It is far better to preserve your capital, protect your mental energy, get some rest, and just wait for a potentially cleaner setup in the New York session.
Ultimately, intraday trading is the business of identifying one pattern: accumulation, manipulation, and distribution. Your job is to find when the market is accumulating orders in a tight range, anticipate the manipulative run on liquidity, and then participate in the real expansion, the distribution phase. The avoidance rules we've covered are simply signals that this cycle is unlikely to play out cleanly. If the fingerprints of this cycle aren't there, you have no business being in the market.
And that brings us to this final, powerful idea from ICT, which perfectly summarizes the entire philosophy behind this lesson. The best rules are the ones that help you stay out of the marketplace. Because knowing when the odds are stacked against you is the single greatest edge you can ever develop as a trader.
If you found this breakdown of ICT's framework valuable, please give this video a like and subscribe to the channel for more. If you have any questions about these rules, drop them in the comments below, and a human will get back to you. Thanks for watching, and trade safe.